Imagine this. You wake up one morning, grab your coffee, and pull up the gold chart, and bam! The market has exploded higher, leaving a massive, nearly 3% price gap over the weekend. Now, a move like that isn't just random market noise, it's a message, a big one. The question is, what is the market trying to tell us? All right, let's get into it. For any trader, this is the million-dollar question, right? When you see a monster gap like this, your brain immediately splits into two camps. Is this a trap? Just a big emotional spike that's about to slam back down and fill that gap? Or is this the starting gun for a powerful new trend? Our job is to play detective and figure out which story makes more sense. And here it is. This is our crime scene. A gap this huge, especially in a market as big as gold, doesn't just happen. This is a sign of serious institutional urgency. Big money was scrambling to get in over the weekend. So we have to treat this gap as the most important clue in a developing mystery. So to really understand this clue, we first have to know what we're looking at. What exactly is a weekly gap, and why is it so much more important than the little jumps we see during the day? See, a weekly gap is a totally different animal. It represents a fundamental shift in thinking that happened while the markets were asleep for the weekend. Some major news broke or a big geopolitical event happened, and it forced everyone to completely reevaluate what gold is worth. That's why these gaps carry so much more structural weight. They signal a real change in the story. Okay, so we know what it is. Now we need to figure out why it happened. What was the motive behind this sudden massive surge in demand for gold? Well, the main catalyst was a major flare-up in geopolitical tensions. And in times of global uncertainty, gold basically wears two hats. First, it's the classic safe haven. When things get scary, investors run to gold for protection. But second, if those tensions could disrupt energy supplies, gold also becomes a hedge against inflation.
Are you ready to level up your trading skills? Visit and follow our TradingView Ideas page. You'll get actionable insights and training materials for free. Scan the QR code or use the link on the screen to keep in sync with the markets.
This gap is telling us that the big players were rushing to get both of those protections in place, and they were doing it in a hurry. So we have the event and we have the motive. Now we need the tools to actually analyze the evidence left behind on the chart. So let's open up our technical detective kit and see what it tells us. Our first tool is Bollinger Bands. The easiest way to think about these is like the banks of a river. When the price is just flowing calmly down the middle, everything's normal. But when the price smashes through that upper or lower band, it's a signal of a huge burst of energy. It's telling us volatility is expanding and something significant is happening. And our second tool is the Relative Strength Index, or RSI. You can think of this as a health meter for the trend. It's all about momentum. Is the trend sprinting, jogging, or is it getting tired and running out of steam? If the RSI gets too high, we call it overbought, which can be a warning sign that a move is getting exhausted. Now, this is where it gets really interesting. Look at how our tools work together here. We can clearly see the prices bursting through the upper Bollinger Band. That's our high-energy move. But then you look down at the RSI, our momentum gauge. It's strong, for sure, but it's not even close to being in that extreme overbought danger zone. What this tells us is that the trend's momentum is actually still healthy. It's expanding, not getting exhausted. This looks more like a beginning than an ending. Okay, this brings us to a deeper piece of evidence, a kind of hidden clue on the chart that most people might miss, but it could be absolutely crucial for what happens next. So let's think about this logically. We know the upward momentum is strong, but what if the market decides to take a breather? If price does pull back a little bit, where's the most likely place it's going to find a safety net? Where are the buyers probably waiting? The answer often lies in something called unfilled orders, or UFOs.
If our videos help you stay sharp episode after episode, hit pause, like, subscribe, and keep learning. Your support means a lot to us.
Now, what are those? Well, think of them like financial IOUs. They're price zones where, in the past, big institutions tried to place huge orders but didn't get them all filled. Those leftover orders just sit there, and they can act like powerful magnets, either pulling price back to them or acting as a solid wall of support or resistance. And if we look back at our chart, we can see this exact thing in action. Right below where the price is trading now, there's a clear identifiable zone of these unfilled buy orders. This is the first major structural battlefield. If gold pulls back into this zone and buyers show up to defend it, well, that would be a very powerful sign that this upward trend has legs. All right, so let's recap. We've gathered all our evidence. We have the gap itself, the geopolitical motive, the healthy technical readings, and this hidden level of support. Now we can lay out the two most likely paths forward. So on one hand, you have the reversal scenario, the gap fade. This becomes likely if the price can't even hold the halfway point of the gap. This would suggest the whole thing was just an emotional overreaction. But on the other hand, you have the continuation scenario. This is the one that gains a lot of steam if that gap midpoint holds as support, and especially if price respects that UFO zone we just found. Given all the evidence we've seen, this path seems to have more structural weight behind it. But here's the thing, and it's probably the most important part of this whole analysis. Our goal isn't to be a perfect fortune teller. It's to be prepared. And that means we have to talk about the most crucial part of any trading plan, managing your risk. When things get this volatile, you have to know your exposure. A standard gold contract, the GC, is a beast. Every $10 price move is a $1,000 swing in your account. But you don't have to trade the beast. You can trade microgold, which is 1/10 the size, or even a 1-ounce contract. This allows you to fine-tune your risk perfectly. And here's the key takeaway.
If our videos help you stay sharp episode after episode, hit pause, like, subscribe, and keep learning. Your support means a lot to us.
Choosing the right contract size isn't just a financial decision, it's a psychological one. It lets you manage the emotional pressure that comes with these huge, fast moves. It allows you to actually stick to your plan instead of panicking at the first sign of trouble. And it all comes down to these core principles. Number 1, size your position based on how wild the market is, not how you feel. 2, know exactly where you're wrong before you ever click the buy button. And finally, always protect your capital first. I promise you, the market will still be there tomorrow with another opportunity. This quote really just nails it. Gaps are these incredibly powerful two-sided events. Yes, they can be violent traps, but when they hold, they often signal the very beginning of a major new expansion phase. The key is having the patience to wait for the market to show you its hand. And that leaves us right here with the final big question. All the evidence we looked at today points towards a real structural shift. But in the end, the market is the final judge. And now you know exactly what to watch for. How price reacts at that gap midpoint and inside that UFO support zone will give us the answer. So was this just a temporary shock? Or are we witnessing the start of a major repricing in gold?
Are you ready to level up your trading skills? Visit and follow our TradingView Ideas page. You'll get actionable insights and training materials for free. Scan the QR code or use the link on the screen to keep in sync with the markets.